You've been pretty early in some major dislocations in this market, be it COVID, be the inflation that followed, and some really successful hedging strategies behind that. Do you see any dislocations like that at the moment and hedging strategies you'd want to deploy?
No, actually. I think we're heading into a very good place. Obviously, we have a war still underway, but I think we have by far the upper hand. I think Iran has been denuded of military capability, and I think it's only a matter of time. Administration, I think, this move of closing the strait, I think was a kind of a kung fu grip type move on the part of the president, and I think it's putting a huge pressure on Iran. So I think we're going to get this resolved in the relative short term. I think that's really the biggest overhang on the market, right? We close the strait, obviously has an impact. Some, whatever, 4 percentage points or something of oil on a daily basis can move a market, and that has an impact, causes inflation in the short term. But I think it's a short-term phenomenon, and I think once we're through it, I do see a Federal Reserve that should be able to reduce interest rates. We have massive, AI spending. We have massive energy spending. We have a tax bill that's driving investment. Every day there's however many deals that are being announced. You have an administration that's very supportive of transactions as opposed to an FTC which would stop everything. So I think you're going to see lots of reasons to be bullish on markets generally.
You were pretty early in this call posting on X that any dips would be short-lived, and they were...
I didn't say any dips. I basically called a recent bottom, let's put it that way. I thought stocks were getting stupidly cheap. So I just sort of called it out.
They didn't even sell off 10%. I feel like some people feel uncomfortable with that. I think oil today is trading somewhere around 116, and stocks feel unbothered.
You can't think about stocks. You're thinking about stocks from an index perspective.
Okay.
The index is like looking at the surface of the ocean. The index is like looking at inside the ocean, but the surface is moving around a lot. And what I mean by that is there are a lot of stocks. There's enormous disparity there's enormous volatility. We have a lot of earnings coming out in the next 24, 48 hours. And you can see massive moves in different directions. There's so much capital leveraged, short-term focused, tightly risk managed, which means stop losses and things like this. And the result of that is that our capital markets, you can see massive moves in share prices. If you have the ability to be long-term, every once in a while, the price of a really high-quality company gets stupidly cheap because someone is forced to sell because of a bad print for the quarter or a guidance change. Really something that doesn't necessarily have any material impact on the long-term business. And those are the kind of dislocations we take advantage of.
But the dislocations, it sounds like, are over. The stupidly cheap moment has come and passed. Is that fair?
I would say we're above stupidly cheap bottom, but I still think there are a lot of very high quality, like the way we sort of model each of our companies, we build a model. And our kind of go forward next 3-year IRR was something north of 30% at the bottom. You don't see that with really high quality companies. It's probably now in the mid-20s. It's still a very high rate of projected return for some of the best businesses in the world. And that's suggestive to me the market's cheap, or at least cheap. This is a case where the highest quality companies are cheap. I'm not saying that energy companies are cheap today.
Sure. So you have to avoid value traps, essentially, in this market as it stands.
I think that's a
true
of
any market. Fair enough.